Third quarter ends flat, debt ceiling still there, and reverse repos are tripled. Let's talk about it. Hello everybody, Joe Warper coming at you. And the third quarter basically ended in a fizzle. I mean, the NASDAQ was barely up, not even 1%. The S&P 500 was down. The Dow Jones was down. The third quarter just did not perform nearly as well as the first and second quarter of 2021 did. And that's to be expected with all of the economic turmoil that we're seeing around the world. Now, overall, economically, the world looks good, but there were two big news stories that hit the headlines at the end of the third quarter. First off, the debt ceiling, which we'll talk about here in a second. But on top of that, we had one of the largest real estate companies in the world, Evergrande out of China, on the verge of bankruptcy. So the fact that the stock market barely turned negative for the end of the third quarter is a testament that things are still good. We haven't even seen the S&P 500 correct above 3% in nearly 12 months, and that's not normal. That tells you that things are stronger than they appear. And heading into the fourth quarter, besides the debt ceiling, there's not a lot of numbers that will come out that could have a negative impact. The only thing that could happen is maybe we have a black swan event that in the short term corrects the market, but long-term black swan events don't do anything. So things are looking positive still for the fourth quarter, even though we're starting out a little negative. But let's talk about the debt ceiling because it's on everybody's lips. It's in the top of every headline. Right now, we have a standoff in Congress. The Democrats want to pass the debt ceiling, and the Republicans, in order to score political points with their constituents, they're now going to say we aren't doing this. And it's absolutely crazy. It drives me bonkers. It drives me insane. And here's why. The debt ceiling has nothing to do with what we're talking about spending for next year. The debt ceiling has to do with what they voted on last year when Trump was in office. This isn't even a Biden deal. This is a Trump deal. This is what our Congress said they were going to spend money on last year. And as I said last week, it's as if Congress ordered this gigantic meal. They got all the food. They ate all the food. They enjoyed it. There were no concerns. Then the check came and they said, you know what? We're not going to pay. Of course you have to pay. And of course they're going to pay. But people are concerned that this could cause the whole economy to go into a tailspin. So let's look. Because we've had this debt ceiling crisis 78 times before, and 22 times the government has actually shut down. So let's take a look at three of the longest shutdowns and how they actually affected the market. First off, 1995, we had Bill Clinton in office. He was facing off with Newt Gingrich. This was one of the longest standoffs we had. This is one of the biggest shutdowns we had. And we can see back in 1995, from November to January, we had the S&P 500 and the Dow both finish positive. Jump ahead to 2013 when Obama was in office. Obama had another showdown and Congress did not give him the spending power he needed. The government shut down. And as we can see here, all three indices during that shutdown were actually positive. Now, the first few days in the shutdown, they went negative, but they all turned up positive. And the negative that they had was only a 3% decline, which again is not bad. And then the most recent shutdown happened during Trump's administration at the end of 2018. And here again, we can see all three indices, the S&P, the Dow, the NASDAQ, all not only returned positive, they had double-digit returns. The economic collapse did not occur during a shutdown. So I'm not worried about this. This is just something to sell headlines. Eventually, Congress will find a way to spend the money that they've already said they're going to spend. We're going to get through this. This should not be a concern. But the articles have to be written. The newspapers have to talk about something. So the newest craze is reverse repos. Reverse repos hit an all-time high and the Fed doubles and even triples them. Well, let's talk about what is a reverse repo or why do we even have them? Well, we're sitting in a very interesting time that right now, banks have over $4 trillion of cash. Money market accounts, as I've said on this channel, have over $4.5 trillion of cash. So banks are sitting there going, what do we do with this money? Banks do not make money on cash. Banks make money when you borrow from them, when they create loans. And as we can see in this chart, loans are actually down. And the reason loans are down is because most major corporations are flush with cash. They have so much cash right now, they don't know what to do with it. So they're depositing it in banks, and banks are saying, we don't know what to do with it. So the banks are doing these reverse repos with the Fed. The Fed basically says, we'll take your cash, and in return, we'll give you treasury bills. And these treasuries will pay them a little bit of interest rather than the money sitting there earning them nothing, because the only way banks make money is if they're lending money, and right now they aren't lending money. So they're buying these reverse repos, which had a high of 40 billion. They were doubled to 80 billion. And then the last day of the third quarter, they hit a high of $160 billion of reverse repos. Again, what this does is this causes treasuries to become scarce. It drives the price of treasuries up, which in return drives the yield down, which is exactly what the Fed wants. The Fed wants to keep interest rates low because they believe if interest rates are low, businesses will borrow money. Businesses borrow money, they'll hire new people, they'll open new factories. This will spur on economic growth. People will buy houses. This will make people feel wealthier. They'll spend more money. It'll make unemployment go down. That's the Fed's job. The Fed's job is to keep unemployment low, keep inflation between 2 and 3%. And so far, they've been able to lower unemployment, but inflation has been a problem. But as I've said, Fed Chairman Powell believes, as do I, that these inflation rates are temporary. He likes to say transitory because it sounds, I don't know, it sounds like he's smart when he says it, but basically transitory just means temporary. He feels that inflation is temporary. I feel that inflation is temporary. It has been driven by supply chain issues, which we saw because of the COVID shutdown. Take one of the biggest supply chain issues we have right now, and that's car manufacturing. And it's not really it's not the manufacturing of the cars, it's the chips inside of the cars. And the issue we're running into was last year when people weren't buying cars, car manufacturers stopped buying microchips. And I don't know if you know this, but the microchips that cars use are basically technology from the 90s. And the microchip manufacturers had all these tools and dies in place to make these microchips, but they were using basically 30-year-old technology. Well, when the car manufacturers stopped ordering the chips, they got rid of those tools and dies. They went to a new set, and they started manufacturing microchips for computers, which are always on cutting edge. Now, the car manufacturers are going back to the chip manufacturers and saying, hey, we need our chips. And the manufacturers are saying, you know what? We don't want to recreate these tools and dies from 1990s. We want you to come out of the Stone Ages. And the car manufacturers are saying, we don't want to do that because that technology is reliable. And when you stick it in a vehicle, you have to have reliable technology. So there's a bit of a standoff. So there's a lot more to the story than what you know, why cars are not being produced. They have to come out of the Stone Ages. We'll see, it's like a game of chicken. Who's going to blink first? In this situation, I think it's going to be the car manufacturers. They will have to develop new technologies. They'll have to stop asking for these antiquated microchips and move into the 21st century. So reverse repos hit an all-time high. They have fallen off of their end of the third quarter highs, and I don't think this is a terrible thing. Again, the Fed wants to keep interest rates low. They keep interest rates low by creating demand for treasuries. Heck, the Fed's buying $80 billion of treasuries every month to keep interest rates low. Eventually, as we've seen, as Powell came out and said, first it was 2024, then it was 2023, now maybe 2022 is when they could start raising interest rates again. I think that's a positive. When the Fed starts raising interest rates, that means the economy is back on track and we feel comfortable with getting interest rates out of the zero market so we can head into getting some better fixed returns. Because right now, you know, you want a certificate of deposit, you might get 1.5%. You want to lock your money away for 10 years, you might get 2.5%. The only place to make money is in the stock market, or if you're willing to take the risk, you know, treasuries when we have a correction. If we have a corrections, that's usually treasuries do well. So it might be a place you might want to take a look at. I hope you liked the video today. If you like videos like this, make sure you subscribe so you see I post 2 to 3 videos every week. Make sure you comment below. Let me know what you'd like me to talk about, and I'll see you next time.